The Fed have started to raise interest rates, and their next move is nearly guaranteed to be a 50 basis point hike, potentially even a 75 basis point hike, with more to come after that. Stock markets haven't taken too kindly to this, but my guest on GoldCore TV this week, financial strategist and contrarian David Hunter, thinks we could still see a melt-up boom that's going to take the Dow to 45,000, the NASDAQ to 20,000, and the S&P to 6,000. He's also revised his price targets for gold and silver for 2022 to $3,000 and $50 respectively. To get his thoughts on exactly how this is going to unfold, watch this video. And remember, if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. David Hunter, welcome back to GoldCore TV.
Oh, thank you, Dave. Nice to see you again.
Likewise. Now, when you were on before, towards last fall, August of last year, you were talking about a melt-up boom in stock markets, where you thought that we might see the Dow go to 40,000. We'd see 18,000 on the NASDAQ and potentially 5,000 on the S&P. Now, lots happened since then, naturally.
Sure has.
And we've seen inflation figures continue to climb. We've seen the narrative in the Fed now swing much more hawkish. We've had one rate hike. We've had talks now of more 50 basis point rate hikes and potentially even 75 basis point rate hikes. And we've seen, since the beginning of the year, a lot of nervousness in stock markets. Now, we've seen a lot of geopolitical tension, and we've got the war in Ukraine and Russia. All of these things, a lot of new things have been thrown into the mix. Are you still confident of this melt-up boom?
I am. And in fact, although right now my sense is there's a lot of disbelief, but in terms of a bull market. But I came into this year calling for a correction. At the end of the year, as you remember, made our new highs, and people were thinking the melt-up was then. And I said, I just don't feel like this is it. There's too many unsettled things. I think we still have to go through a correction before we get that melt-up. And obviously in the last 4 months, we've had that correction. I came into the new year in my first quarter letter, raising my targets, even though I was looking for a correction of 10% or a little more. I raised my targets. So my Dow target is now 45,000. My S&P target is now 6,000, which had been 5,300. And my NASDAQ target is 20,000, up from 18,000. So I'm not sure everybody understands that I can be looking for a correction ahead of that, and yet still be raising targets because of what I'm seeing. So my bigger picture just said this thing has more legs. And frankly, what we've seen in the last 4 months, and particularly what we've seen in the last week, the sentiment is at levels we just rarely get to. You know, the bearish sentiment now is sky high. We're back on many measures, we're back to March of 2020, or, you know, maybe even 08, 09. I mean, people are just really nervous, as you say. And I think that I'm a contrarian, and that is what I call the fuel for the next leg up. So, you know, I'm calling for a final parabolic leg to a 40-year secular bull market. I think we started in August of 1982. The Dow was down at 780. And we're now obviously, you know, moving towards mid-30s and maybe 45,000 if I'm right. So I do think there's one last melt-up leg. I've said on Twitter often, it's not that we haven't had a melt-up. Certainly the doubling in the market from March of 2020 to the end of last year qualifies as a melt-up. What I'm calling for is a final, even steeper parabolic leg to that secular bull market.
Okay. What's the fundamental basis of this call for the melt up? because
Sure,
as you say, we've got an awful lot of bearish sentiment at the moment. So I'm quite sure, despite the fact that you're contrarians and contrarians tend to be in the minority, I can well imagine that there are a lot of people looking at your calls now and saying, there's not a hope.
Yeah, exactly. I've been called an idiot. I've been told I'm crazy, etc., because people just can't possibly see how you can get there. And I admit it's an extreme call. And from the standpoint of if you look at current fundamentals, you'd have a hard time justifying. I mean, the Fed is raising rates and clearly has indicated they want to raise further. Inflation is at this point, at levels we haven't seen in 40 years. There are a lot of reasons to be bearish, and certainly many people are. As I tell people, I'm not a technician, although I look at technical work. I'm a contrarian. So whereas technicians are looking at ever lower prices on indexes and getting, they're saying they're breaking down below support levels, I'm getting more bearish. I go, I'm a contrarian. Sentiment probably is the most important thing to me. Sentiment is at levels where I'm getting more bullish, not more bearish. The fundamentals that would drive this, or the narrative that would drive this, the rationale that I'm saying is there for this, is basically, I think we are at the peak in rates, particularly, bond rates. So the 10-year at, get up to 290 or wherever, 290 and change. The 30-year get up to 3. And I think they are beginning to roll over. I think we're at a level because what I said coming into the year is that the tightening's actually been, a lot of it's being done by the bond market. So everybody's looking at, is the Fed going to raise rates, earlier in the year 4 or 5 times. Now it's 7 times this year, and maybe several more times next year, even maybe 7 times next year. And I'm saying we're not going to get close to that the bond market's already done the tightening for the Fed. So we may even be 2 and done. You may get the 50 basis point hike. I think that's pretty much in the cards for May. And they may take a look and see the economy is really decelerating quickly, and they may not get to a hike in June, or they may have to pause and hike later, or they may hike in June. But I think beyond June is really a question as to whether you're going to see tightening. Everything I see in the setup tells me we're closer to the Fed stopping than this long runway of rate hikes. So that's a big one. If you go from a tailwind of Fed hikes, which we've had since really last summer, talk of Fed hikes, if that all of a sudden becomes if you go from a headwind of Fed rate hikes to what it becomes a tailwind, where people say the next step is the Fed has to ease, that's a big thing for the markets. Go back to March of 2020. We didn't have good fundamental backdrop, but we had the Fed easing. I'm not talking about that kind of ease, but I think the next few months is going to surprise the Fed and everybody else in terms of how fast this economy has decelerated. Housing is looking at a doubling in mortgage rates. You're seeing autos are still having problems with inventories. You're seeing a consumer confidence. The Michigan Consumer Sentiment Index is at levels that typically indicates recession. So you are seeing adjustments to the economy. The Fed was just late to the move. The bond market took care of it for them.
So the fundamentals, you said that the economy is going to decelerate a lot quicker than everybody's expecting. We've still got a problem with inflation, but how do we reconcile a rapidly decelerating economy with a call for 45,000 on the Dow?
Yeah. So what will happen, I think, if I'm right, is the street's going to look and say, okay, the economy's, the Fed and the bond market already did their job, so easing's coming. We're not talking about a hard landing. It looks, this is again the street saying it looks like a soft landing, and now we've got the Fed back on board with liquidity coming. Whether it comes or not, the narrative will be that it's coming, and that will help fuel it. And that in the backdrop, with the backdrop of a wall of worry that's sky high, provides fuel. That's why I think this becomes very fast. I think it's steep because everybody is so bearish and assuming that we have a lot more downside and that the cycle's over. And frankly, as you know, on the other side of my call is that there's a global bust coming on the other side of the meltdown. There's a lot of people now buying into that. When I originally talked about it, it seemed crazy. Now that's what the fear is. The fear is Fed's going to overdo it. We're really going to, with the leverage in the system, we're really going to crank down. That's my call, but it's just not for right now.
So it's just it's a matter of timing.
It's all timing, and it's. I think we're just in a cycle and an environment with investors being traders rather than investors, where they move very quickly one direction, and then when they see things change, they move very quickly in the other direction. And you can get a very explosive move, but then have it over in 3 to 6 months.
So you might consider that the market is fairly oversold at the moment, and that in any sort of what could be considered positive news, or that positive news might be a decelerating the economy. Positive in the fact that the Fed, the work that they have done is having an impact. Whether it really is or not is besides the point, but that the market might take this as, okay, this is relatively positive. The next thing that's coming is potentially more liquidity into the market. Right.
And again, we don't know whether the liquidity will actually be there. I mean, there's plenty of money on the sidelines. The Fed put $5 trillion in the last 2 years, so there's plenty of money out there. It doesn't necessarily need more money, but it needs the market to believe there's more money coming. And so I think that's part of it.
So your calls are based on what you expect the perception of the market is going to be at that stage, rather than what the actual underlying fundamentals of the market
right
is.
Because I do think that the Fed probably has already, believe it or not, even though they've hardly tightened or done much, I think what the bond market's done, and let's remember, we had the 2-year go from almost zero rates up to over 2.5 in a matter of months. That's a big move, particularly given the way rates have been the last few years. I mean, that's a huge move. And again, across the yield curve, we've seen, all the rates back up very rapidly and go from, what seemed like an impossibility that we'd have an inverted yield curve to an inverted yield curve in a hurry. So I think there's been a massive tightening that, because rates are so low and because real rates look crazily low, people aren't recognizing. But I think it's that rate of change that can really throw things off. I mean, the housing boom in the U.S. was fueled by 2.5% mortgage and rate, and now it's over 5. It makes a huge difference on what people can afford and what people will be able to pay for a house. So I think you're going to see housing come in here very quickly. Inventories are relatively low, but so the home builders may still have a little bit of wind at their back for a few months. But in terms of the overall housing activity and refi, et cetera, things that have been fueled for a consumer, I think that game's over.
And the fundamental aspect that you might be looking at in this term, in terms of seeing evidence that the Fed's having an effect, whether it is or whether it isn't, what would that be? Is that going to be a slowing of inflation, do you think?
Well, I do think that's the other part of it, but I do think you're seeing it in PMIs, and you're seeing it, and we'll see it more so in PMI, Purchasing Manager Index. You're seeing it in, some in housing, and I think you're going to see a lot more in housing. You'll see it in the retail area. Now, what confuses it some, and what may help in terms of the rally, is at the same time, I think we're getting an opening up where there's a lot of talk about booming travel. People are saying, hey, COVID's behind us. We feel more comfortable flying. We feel more comfortable vacationing away. So you're going to see this summer, I think, on the one hand, certain things that are really interest sensitive being hit by the economy. On the other hand, the opening up, being kind of a bifurcated situation. So it's going to be very hard to really determine, is the economy coming or going? Which way is it? And I just think the half glass empty mentality is going to change to half glass full, and you're going to see it off to the races. But because I think the Fed not the Fed, but really the overall tightening narrative over tightened, you may be already seeing the seeds to the global bust. In other words, it's not necessarily going to be, okay, we have a quarter that's weak, and then we're going to have a boom, and the bust is put off. This may all be kind of working towards the bust for a period. I think the market's going to be responding as they did in March of 2020.
Is there anything that that would make you reevaluate and say, okay, this isn't going to happen? We've actually seen the melt up boom already in stocks over 2021, and we're actually now into that sustained bear market.
Yeah, I think the bigger issue, because sentiment is so low, so bearish, I think you're going to get some rally out of this. The big question is to watch that rally. If I'm right, this thing is going to move out of here pretty quickly, and in the next month, you're going to see that we could be at highs. Certainly be at highs this quarter, maybe even be at highs by the time we get to June. If that's the case, that feeds my narrative or my call. If it struggles, so I think it's the next rally where you're going to be able to judge. It's, I know what the sentiment on the street is that the market's breaking down and we're heading for 3,700. I mean, that's the broad consensus view right now. I think because of where sentiment is, the more likelihood, the greater likelihood is that we're very close to a bottom here, and it's the next rally that will tell you whether it's a bear market rally or a bull market rally.
Okay. And how does gold and silver perform over the short term in terms of this next melt up rally?
Yeah, I think gold and silver got hit very hard by the rise in rates. Obviously, this most recent move down in gold and silver, rates moved pretty quickly in the first quarter. So I think this is kind of in response to that. I view where we are right now as a true bottom in the metals. They obviously started moving better in the first quarter, and then kind of hit a place where the last few weeks it's been tough. So I think we're either at a bottom or very close to it, or the end of a correction. And I think you're going to come out of this very sharply. I mean, I think you're going to see new 2022 highs within a matter of a couple weeks or a few weeks. And then on its way, where I still have actually raised my target on gold to 3,000 for this year. I had been at 2,500, and my silver target's been 50. That's pretty aggressive, so I didn't raise that. But that's where I think we go this year is, silver to 50, gold to 3,000. And the miners have been hit pretty hard here, short term, harder than the metals themselves. I think are bottoming here and should have pretty good runs in the second quarter and third quarter.
Now, you're obviously most well known recently, particularly on Twitter, for the call for the melt up boom. But ultimately, what you've been saying is that you're going to see this melt up boom, but then you're actually going to see a sustained and bear market after that, and you're looking for a significant correction in stocks. I think the calls, even an 80% correction in stocks. We've seen numbers like that in some stocks, particularly tech stocks, over the last while. You're saying that's actually going to broaden. What's going to be the trigger, the capitulation point for the market, do you think, after this melt up boom?
Yeah, I think, like I said, I think some of the seeds for that bust and for the bear market are already sown. In other words, we may have really, the economy is fragile, both here and abroad. The pandemic really added to the fragility. my whole bust scenario is basically saying we're coming to the end of a economic cycle, since 2008-9, recovery cycle, and the next downturn, because of the massive leverage in the system, and I talk about 300 trillion in debt, global debt, along with quadrillions in notional value of derivatives. The two of those things combined are just leverage beyond anything this world's ever seen before. And they're just going to take a normal downturn and make it into something worse. So that's really the essence of why I call it a bust, or why I think it's going to be bigger than 2008-9. The timing of it, why I think we can have a very fast run up and melt up in the market in a melt up, and yet still be talking about a bust starting by the end of this year, is because I think the tightening we've already had has done much more damage than people realize, and has kind of started the process. It'll be interrupted. The Fed's you're hearing talk now that the Fed's thinking maybe we need to really rein in the balance sheet. We did increase it by, 5+ trillion. Maybe it's time to take $1 trillion back or more and do it at 100 billion a month or whatever they're talking. I think what you might have, and again, this is speculation because we don't know what the Fed will do, but I think what you might have is they hike rates in May, 50 basis points. They either hike in June or they don't hike because the economy has shown enough weakness that they want to wait. But that they say, but we're going to continue to shrink the balance sheet anyway, because that's, for whatever reason, they think that's less damaging to the economy, that we just have too much liquidity around. I think I'm a monetarist. I think you pull a balance sheet in by $1 trillion or more, and you've got the reason why you're going into a downturn. And like I said, and then you find out that downturn is a lot worse than you can control because of the leverage. And again, this is just the US. We've got all kinds of issues in China and their slowdown. We've got all kinds of issues with what Europe's had to go through with their energy crisis. And so, I think the world is really in a very difficult place. And what's funny, right? Not funny, but what is a little ironic, because for a long time people thought I was crazy on the bust call. Now that's an easy one. Everybody goes, well, I agree with your global bust call. I just can't see how you get a melt up. So, of course not. The market's just, really hit the skids. But I think, investors are momentum driven. And I think if we get the market coming out of here, as I expect, NASDAQ's up 99 now. I think we may have seen the lows this morning to this pullback. If we find this thing starting to go, you're going to see people switch gears from, the sky is falling to I got to get on board, and that's what it's not. I'm as I tell people, I'm a macro strategist. I'm forecasting what I think will happen. I am not telling people whether to play this rally or not. It's in the end, it's a short-lived rally. The thing that makes it hard is that I'm talking about 40 to 50% upside in stocks in a matter of months. That's 3 or 4 years worth of returns. So even though it's only very short, it's going to be so steep and so compelling. My concern is those that are bearish today will be all in at 6,000 and telling me why I'm wrong to turn bearish. You know how psychology works.
Indeed. So we could be 6 weeks away from this, is what you're saying, because you think that we might see a hike, or we're going to see a hike from the Fed in May. You could see another one in June, but at that stage, we're going to have a little bit more information about how the economy is actually reacting. And we might see them pause at that stage, potentially. And that could be a signal for the market to rally higher from there. But then as that unfolds, we might see our melt up boom there. As that unfolds and numbers continue to persist and be poor, and the Fed may or may not attempt to remove more liquidity by shrinking the balance sheet, we're going to start to see that. You
could potentially, and I didn't answer your question before about inflation. I actually think inflation at least temporarily, maybe peaking. I think oil could roll over here. And some of the spikes in the metals and other commodities from what happened with Ukraine, you could start seeing some of that go the other way. So you could have a period this summer where it looks like inflation has peaked and is rolling over. You could have, and where the economy is rolling over, and the Fed says, okay, I think maybe we've done enough. Let's pause. And like I said, their idea may be to split it and say, we'll pause on rate hikes and we'll shrink the balance sheet on a steady basis. We're not going to go crazy. We're just going to do 100 billion a month or whatever. And most people are going to say, that's not so bad. You put 5 trillion in, you're just pulling back a little bit. So I think the street won't be spooked by the 100 billion a month. And so they can, the market can go merrily along because the Fed stopped hiking rates, or at least it looks like they paused. They may get to, September and say, we've got a market at, up on stilts, and we still have inflation at relatively high levels, and maybe inflation paused and started turning up again. Who knows? They may come back and hike again, and certainly could accelerate their balance sheet reduction. I think those things may be what comes as we get further into the meltdown. Because if you go from, where we are in the market today, the S&P 6,000, if you go up 40, 50% in the market, the Fed's going to be right back on the side of financial conditions are really risky here. We've got speculation through the roof, and we need to temper that. So, again, I think as investors, oftentimes we think, or too many investors think in a linear fashion. These things can happen kind of in two directions, and then ultimately have a conclusion that you won't like.
Before we wrap up here, David, can you tell our viewers how they can find out more about what it is that you do?
Sure. Yeah, I might. As I say, I'm semi-retired. I've been in the business 49 years, so most of my time now is spent on Twitter. Putting out my views, answering questions. So you can find me on Twitter at Dave H. Contrarian, and I would caution people there are lots of fake accounts out there that will make it look like it's at Dave H. Contrarian, but they'll spell Contrarian wrong, or they'll have something there. So just be aware. I've got 175,000+ followers. Those fake accounts have, maybe a few thousand. So be careful. Just don't get sucked into somebody soliciting you. I don't solicit people on Twitter either. So if you either get solicited on Twitter or on Telegram, that's not me. I do have an investment letter that I offered by subscription, but the only way people can find out about that is to direct message me on Twitter. So I never talk about my letter publicly on Twitter, et cetera. So just know, if you see somebody out there trying to sell you a service on Twitter, that's not me. Even though it has my profile picture, it's not me.
Hopefully this is something that Elon Musk can solve for us.
Yeah, I think so. He's talked about doing away with the bots, or really tackling that issue. My sense is Twitter didn't want to. So I think we'll see some improvements on that side.
Indeed. What I'm going to do, David, is I'm going to put a link to your profile on Twitter in the description below this video in the show notes. So anybody that wants to follow David, click on that one and I'll guarantee to get through to the correct one. But for now, David Hunter, thank you for joining us on GoldCore TV.
Yeah, thanks, Dave.
Thanks for watching. And if you enjoyed this video, make sure that you check out some of these interviews that I've done with some leading industry experts. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.